All right, guys, welcome. It is Wednesday live. We have Josh back this week. Last week we had Kyle Seagraves of Win the House You Love. I got a little feedback here, guys. Sorry, there we go. All right, so hold on, guys. Sorry, here we go. All right, so again, thank you guys for watching. Here every Wednesday. Like to start by saying thank you guys first off for the support and for being here. Josh got a new camera. Look how clear he looks good over there. Is he he's still muted though? There he go. Hold on, is he still muted? He's muted.
Now can you hear me?
I can hear you.
I was going to say, I got tired of all of the lady followers talking about how handsome Jeb is over there. I said they just need higher clarity. They need higher resolution to fully appreciate my beauty.
Too good. So, hey guys, would love to know what is happening in your markets right now. So if you're out there, wherever you are, let us know where you're watching from. State, city is helpful. And then also kind of a little brief, you could do the number scale on a scale of 1 to 10, how hot your market is. Or just kind of give us a little intel. And if you're in the process of buying a house, what the process has been like, all that stuff is very, very helpful. And I didn't mention Happy St. Patrick's Day. We already have a little super chat from GD. I will get to that in just a minute, GD. But anything to start off with, Josh? I don't want to get into rates quite yet because, again, it's one of those questions that a lot of people have that I know we're going to address multiple times. So let's just save it for a bit. And then kind of jump into it later on in the show.
We're going to talk about the elephant in the room, which GD already hit at with his green super chat, that it is St. Patrick's Day. So in honor of St. Patty's Day, Jeb and I are having a little 805. And it's not green beer, but it's brewed with lime. So it has a little green in it. So it's the closest that we could find at the store to green beer. So hopefully you guys are all having green beer and corned beef and cabbage and all the wonderful holiday festivities while we're partying here on the YouTube Live.
All right, guys. So let's just start it off. Let's get people going for what they're here for. GD is military. So start by saying thanks for your service. Appreciate you. Moving to upstate New York in the summer, got pre-approved for a VA loan, planning to buy and sell 2 to 3 years afterward. So planning to buy and then sell 2 to 3 years down the road. Is that good? Hard to say, right? We don't know what the market's going to do in 2 to 3 years. In this market, what I tell most people, and Josh will probably have his own opinion on this, but I think you need to start from a longer term perspective. My thought in mind is say 5+ years, 7+ years, I think is a good number to have in mind. And not because I think that the market's going to change in 3 years. I do think home prices are going to continue to rise for some time. But we don't know what's going to happen, right? There are, as Josh mentioned a moment ago, the elephant in the room. The elephant in the room right now is all the money being pushed into pumped into the economy. And in fact, there are several elephants in the room, right? You've got forbearance, you've got all of these things that at some point are going to come to fruition and need to be addressed. So I think 2 to 3 years, hard to say, what it's going to look like, but I definitely think in 2 to 3 years, it's probably worth more money than it is now. Just, it's really, it's all local, right? If you were in Southern California, I would tell you that you're probably in good shape. I don't know upstate New York very well, but Josh, what are your thoughts on that?
So I always like to start with, in your best case scenario, unless you are a realtor or have a family member that's a realtor that's going to sell your house for free, you're looking at about 5% in costs. So in this situation with a VA loan, I'm going to make the assumption that it's a zero down. Not all veterans use the zero down option, but most do. So with zero down, you are essentially 5% upside down when you start. You need 5% appreciation to get back to being able to sell and break even. So 2 to 3 years is a pretty short time horizon for that. So I would always be careful with it and account for the selling costs. Everything that we talk about on this show, Jeb thinks, I think, and again, all real estate is local. We're trying to apply what's happening here nationally, which for the most part is accurate at this point. But But if we're projecting 2-3 years forward, you probably are going to have 10 or 12 or 15% growth, possibly even more. So I wouldn't necessarily call it a caution. I just always like my buyers, my borrowers, to know on the way in what they're likely looking at. As Jeb said, that's a short time horizon to be thinking of getting in and out of the market. Things could happen, go sideways, and make it not work out exactly the way you hoped or expected it to. So that would be the bigger thing that I would count in there. The advice I would have for any veteran, I'm in a big veterans forum for real estate and mortgages on Facebook. We got over 20,000 veterans in there asking questions just like we ask and answer here. And it blows my mind, because of the marketing dollars behind Veterans United and behind Navy Federal Credit Union, how many people have been pre-approved by them and have bought the marketing message that it's great terms and that they're there for veterans. Both of those groups are large for-profit organizations that make money off of veterans by providing suboptimal terms. From Veterans United perspective, they have a ton of overlays, meaning guidelines that are not VA guidelines that they will tell you are VA guidelines. So I just always, it's good that you've been pre-approved. Hopefully it's not with one of those organizations or a big online call center, but especially for veterans, make sure you're talking to a broker in addition to anyone else that you've talked to, just from the standpoint that the numbers can vary so massively. If you look at the data that gets released, some of the big national call centers like a Veterans United can be as much as 1% higher in interest rate than a local broker. And none of us need to be told that 0.5% makes a huge difference both in your monthly payment and what you qualify for.
No, absolutely. That's it's good stuff and something to keep in mind. I mean, that's one of the reasons that we're saying if you're getting pre-qualified, even if you're doing VA, it's good to check with multiple sources, a broker, a bank, to try multiple people just so that you're getting the best of terms. Because, typically VA has better rates along, FHA and VA typically have better interest rates than that of conventional. And it's really easy to think that you have a better rate than some other people out there because, you're being quoted or you're being quoted less than what somebody that maybe got a conventional loan received. And so you think you're getting a good deal, but maybe you're not getting the best deal. And so that's why it's good to shop around. So long way of getting there, but let's dive down some more questions. Also want to thank Jennifer Lego for being here and being a moderator. You're much appreciated in helping us out. So let's see, just diving through some stuff here. We got some people saying it, buying and selling at the same time. That is extremely difficult in this market unless you have the ability to purchase without contingencies. We got people from Illinois. We got Chris from Maui saying the market is super hot. Ventura.
Jeb, I have something here that I think these guys will find interesting on that topic of what you just said. I'm going to tell you a scenario and you tell me. I don't think that the realtor in question here necessarily, they didn't give bad advice. They didn't give the best advice. So I meant to ask you this off air. Lori on my team here, her daughter sold her house recently, knowing that she was moving to the Temecula market. Also, I mean, everywhere in Southern California is on fire right now, but a very competitive market because it's more affordable. So she sold in Rancho Santa Margarita, moved to Temecula. And rather than putting a contingency in for them to find their new home, they said, well, you'll never get an offer accepted, so you have to sell it and do a 60-day rent back. So they ended up on about the 48th day, they got a home under contract that they had to win a bidding war. You see a lot of the comments here, people asking today, I'm not overpaying, I'm not getting into a bidding war. They literally had no choice. They had nowhere to go. They had to use their proceeds from their home here and win that bidding war. So they're happy. They ended up getting a good home. They got a fantastic loan. But at the end of the day, just what are your thoughts? How do you handle that? You have someone that has a bunch of equity. They're going to be selling their property and they have to. They outgrew their home. They had their second child. They couldn't stay in their condo. So they have to move. What's the advice for that person?
That's tough. The advice that I'd like to give is different sometimes than what I do give because of the situation. Recently we had the one here locally that you were actually doing the loan for them. And I don't even know if you know this, but it's dead at the moment because they've decided not to sell. This is a situation where a seller was selling their property and buying something more expensive, and they were contingent upon finding that replacement property. So a lot of people in the market are like this. These people were absolute dead set on not selling their property or doing a rent back or doing anything along those lines unless they found that replacement home. Well, we had a buyer in escrow for 3 or so months. I don't remember exactly. That buyer got tired of waiting. And during this time, that seller found multiple properties that they wanted to write offers on, and they did. And some they had the opportunity to win, but they chose not to do what it took to get those properties accepted, which in some cases were bid a little bit higher and what have you, even though they received almost $100,000 more on their property than they thought they would receive. Nevertheless, they basically got discouraged, and were in a position where they didn't want to move forward, and we ended up just canceling their listing, or we withdrew it from the MLS here within the last week, just because it was almost a battle to some extent, and not like there was any issues between us, but them truly understanding what they needed to do, taking advice from somebody that does this every day. They weren't willing to take that advice, and that advice being, do a rent back, do a longer term escrow plus a rent back. It gives you enough time. Take advantage of the market now. You're getting $100,000+. In fact, when we relisted the house, we listed it higher and ended up getting even more money. So they were going to get like $120,000 more for their property. I said, take it, rent somewhere for a little bit, and let the market just kind of see what's going to happen and find something. They weren't willing to do it. So to get around to your question, you've got to be willing to sacrifice on one side or the other. And the sacrifice is meaning you've either got to sell it with the idea that you're going to rent back, with the idea that maybe you don't find something at the end of that term. That's a sacrifice. Or you sell it, outright, with the sacrifice that maybe you're not going to find the right home in this time frame, and you might have to rent, or there's a lot of sacrifices. So I don't know that there's a right answer in this market. I mean, it really depends on each situation's a little bit different. Somebody with kids, I mean, that's hard to recommend that they do. But the reality is, getting an offer accepted with a contingency in place is definitely tougher. But if that person is in escrow, right? So I had this client in escrow. We were making offers contingent, but more or less all contingencies had been released outside of that contingency. And so we were in a very strong position, and we could have gotten offers accepted. They just weren't willing to do what it took. So I still say you keep that contingency in place, and just try to find that buyer up front, because there's a lot of people right now willing to wait, give people enough time, just because they see where the market's going. If they can buy a property today at, say, 600,000, or wait 2 months and buy that same property at 640, chances are most people are gonna say, I'll do it today, and I'll wait for you to find that house. And in most cases, if you're motivated at that point, you can find the property, and your agent can do things outside of the norm. If you know where you want to be, they can beat the drum, so to speak, and try to find something. Unfortunately, these clients that I had no idea. They had like 5 cities, and it was all over the board. So it wasn't as easy.
The worst part in their situation is they had the one that what was it, 10 grand they let it go for. And if you offered them the opportunity to do it again, they would have absolutely paid the extra.
1,000%. And that same house today probably sells for $30,000 more.
So Jeb, you're going to like this. This genius talked on the phone too much today. This headset is about to lose its battery. So take a question or two solo. I'm sure you are more than capable of doing it without me. I'm going to find another headset to plug in here.
All right. Sounds like a plan. All right. So I'm going to go through some questions here, guys. So we got a lot of people saying the market's crazy wherever they are. George or Jorge Realty, I'll come back to you and let Josh address the question of current interest rates. Most lenders use a rate sheet from a couple of different lenders to get to quote interest rates versus, say, a website in most cases. But I'll let Josh address that in a moment, just to give you some some actual information on what's going on. Pogimoto is asking, what is a Hoover clause, and how often do sellers put it in the contract? That's a new one for me. I'm not sure of what a Hoover clause is. I will Google it here in just a minute as we get Josh back and see if I can find some information, and I'll come back on that question as well. Can you talk about a 203K loan? Do you need a pre-approval for a 203K first? So a 203K loan, if you're familiar with it, again, this is also something Josh can talk about when he comes back, is an FHA loan. So an FHA 203K is a loan where they allow you to rehab a property. And what that means is that you can buy a property that needs work, a distressed property, if you will. And when you purchase that property, there's a couple of different things of how this works. And I'll get into that in just a moment. But you're asking, do you need a pre-approval for a 203K first? Yes, for the most part. I mean, it's not necessarily for the 203K that you need the approval for, but you need approval for an FHA loan up to whatever the amount the 203K loan is going to end up being, because that's the amount that you're going to have to qualify for. But how that works is you buy a property using a 203K loan. Essentially, the appraiser appraises the property as is right now, and then they appraise it in its future value once the repairs, the rehab that you plan on doing are completed. How do they know what rehab that you plan on doing? Well, you have to get bids for those items. So if you're planning on redoing the kitchen and redoing the flooring and the paint or whatever, you've got to get a licensed contractor to give you bids on those items. Those are provided along, to the appraiser, and the appraiser appraises the new value based off of that information, and the lender will lend a loan based off of the new value. So that's how a 203K loan works in really simple terms. But the idea is that you just need to be approved for the maximum of whatever it is that you're trying to qualify for, whether it's FHA or an FHA 203K, just so you have an idea of how that looks in that scenario. So hopefully that was helpful. Al is asking, what kind of cameras, lenses, and lighting are you guys using? I think we both are. Well, I know for a fact we're both using Sony A7 IIIs for the camera. Lenses are a little bit different. I believe he's using a Sony lens. I'm using a Tamron lens. I think mine's 18 to 29 or 17 to 28 millimeter, somewhere in there. And I believe he's actually using a 35 millimeter lens, somewhere in that ballpark. So hopefully that is helpful. Jonathan asking, putting in 25% down, if your appraisal comes lower than purchase, can you restructure the loan to lower the down payment percentage to cover the difference? Monthly payment will change. Yes, assuming you qualify. So if you're buying a property, you're putting 20% down, 25% down, whatever it is, and the appraisal comes in short, and you need the difference in what you were going to put down, or maybe you have the money and you just say, you know what, I'm going to take the difference anyway. I'm going to finance less, or finance more rather. You're going to take that loan to say 80% and use that 5% to pay off the difference. As long as you qualify for the 80%, then there shouldn't be any issues. In fact, you can change that however you want, but understand at that point, if you've written your purchase agreement as a 25% down loan and it changes to a 20% down loan, the other side in theory has to be okay with you restructuring the loan because you've changed the contract. Now, in most cases, it's not going to be an issue, especially if you explain the situation and say, hey, look, the appraisal came in less. I'm just restructuring this so that I can do this. Most people would be cool with it. But I've seen, where that becomes a problem is that you say that you're going to do, 20% down, and then you end up doing an FHA loan at 3.5% down, and then you need to change the contract to an FHA loan. That's not cool, right? If you're changing the loan terms because you're putting the money towards something else, then you're probably fine. You back there, Josh? Nope.
Now.
There we go. You sound like you're in a bathroom, but it's okay.
Yeah, it is what it is at this point.
No, it's all good. So we are moving forward here. So there was a couple of questions that came up while you were gone that I'll ask you real quick. And if you have an idea of what these are. The first one, Jorge Realty or George Realty was asking if there's a website you use to get current interest rates. I said that you're probably typically using rate sheets of some sort to quote rates, but is there a website that is reliable that you feel like people could use to get an interest rate update?
So we talk about the downsides to the Freddie Mac primary mortgage market survey. It comes out every week. It gives you a ballpark idea, but it's a week out of date, even when it comes out. So from that perspective, I don't love it. If you look at Optimal Blue is the biggest pricing engine in the mortgage industry. They do their Optimal Blue Mortgage Market Index, and you can look at those. I don't think you have to be a member to look at it. And that's locks as recent as yesterday, showing you, and it breaks it down to program type, VA, FHA, and number of points, all that fun stuff.
Gotcha. All right. And then the next one was Pogimoto asked, what is a Hoover clause? And how often do sellers, buyers put it in the contract? Familiar with the Hoover clause? I have no idea what that is.
Never heard of a hover clause.
Hoover. Yeah, I guess Hoover would have two O's, right? That's the North Carolina in me. All right.
You'll get up that hill. Don't worry about it.
Hey, Hill or Hill? Hill.
One of the two.
So Elizabeth is saying, so if my lender's not letting me know if I am qualified, he said that he needs to send my documents to the underwriter. Should I be worried or shop around? So this is common, Josh. What are your thoughts on this?
Well, you and I had this conversation earlier today. I spoke with a listener here, a viewer who had reached out to you. You connected us, and she said a week ago she had spoken with a lender, and the lender was concerned that the credit score wasn't good enough. We needed a higher credit score, so I'm going to have to research it. Well, it doesn't take a week to find out whether you have an investor that will accept a credit score. So this could go either way. Like, we do honestly have situations where there's enough complications, let's call them complications, in the file that we would want to get an underwriter's eyes on it. And in that instance, we're basically doing what's called a TBD approval. So the property is to be determined, but everything else goes in the file. So all your income documentation, all your asset documentation, your credit, all of that is fully underwritten so that you know ahead of time. What I will say is that is incredibly rare. We do it about 2 or 3 times a year. We come across something crazy enough that we need the full-blown underwriter's opinion ahead of time. So unless they can tell you something that's super funky in there, a long way of saying it happens. It does happen, but it shouldn't be common. If there's nothing real big curveballs about your situation, the lender that you're working with 99% of the time should be able to tell you what you can be approved for without putting it in front of an underwriter.
All right. Good stuff. You missed it last week. One of the viewers said that, because I always say good stuff when you're done, he said he was going to get a t-shirt. If I got a t-shirt made with good stuff, he would buy it. So thinking of my new merchandise.
I think you know the little outlines of the heads. We need a little Jeb head outline there, and it just says good stuff underneath it.
So Michael Duree is asking, looking at 3.2 on a new build, worried about the rate going up based on the time he's closing. If it goes up, how long would I need to wait to refinance?
So it's a loaded question. FHA and VA do have waiting periods before you can do either a streamline refinance or an interest rate reduction loan, which is the VA version of a streamline. Those don't require full income qualifying. You don't have to provide all your documentation. So with those, you generally have to wait 210 days from closing. The guidelines are slightly different between FHA and VA, but from the time you close, about 210 days before you could do a refinance. On the conventional loan, there's no such requirement. You could do it 2 days later. What I always like people to know is that whoever the lender is that did your loan, most likely, if they do loans the way we do, we've talked about this 1,000 times on the show, we don't have you pay points. So we do get paid. We don't work for free. And the pay generally comes from the lender that makes the loan. So we're a broker, we place the loan with the lender, and they pay us. And they make that money when they sell the closed loan into the secondary markets. So when someone is buying a loan and paying a premium for it, which is what that upfront payment is, they expect to have that loan on their books for a period of time. If that loan pays off in less than 180 days, we repay everything that we made on the loan, and then any premium that was paid to you to cover your closing costs. So we can not only have to pay back all our commission, but then anything above and beyond that was used to benefit you. So I like to tell everyone, there is no prepayment penalty on the conventional loan. There's no prohibition against you paying it off in 2 or 3 months, but do the right thing. If the person did right by you on the way of putting that loan on the board, go at least 181 days before you have it pay off. We have a client right now that Jeb, you and I helped. They had to buy before they sold, so we had to do a little different financing than what they wanted, and that closed in November. We cannot close until May. They could run out to another lender and do a refinance right now if they wanted to, and they understand. We told them up front what it was, and they are being good for their word that they're not going to pay it off before 181 days, despite the fact that rates are going up right now.
Yeah, and keep in mind, so also, Michael, is that it's also got to make sense, right? I mean, you're at 3.2 or you close at 3.2 hypothetically, at some point, based on what it's going to cost you and what have you, it may not make sense to refinance if rates just go down to 3% based on, your loan amount or what have you. So it's also got to make sense. And a lot of times if you just closed on a transaction, it's going to take a couple of months in a lot of scenarios. Now, we've seen some crazy things in the past year where people were able to refinance maybe twice last year, just depending on where they were. Not usually the case, and normally there's some time built into that. So, but I think that was good stuff. Let's see here. Anything you see, Josh, jumping out at you?
He followed up and asked, Michael asked a follow-up question here. Any way to lock in an interest rate now on a new build that will not close until the end of summer? You can. It's just so expensive to do so. We've talked about this on the show that a lock out to 45 days, 15 days is better priced than a 30, which is better priced than a 45, but they're all relatively similar. Once you go to 60-day, 90-day, 180-day locks, they get really expensive because the lender doesn't want to be overly exposed to a big move in the market. So it means one of two things. Either you're paying money up front or you're just not getting that attractive of a rate, and you're better off just letting it float and see what happens with the market. Jeb, I don't know what your thoughts are in kind of jumping into the interest rate conversation at this point, but it's that timeline and not closing till the end of the summer is going to be really interesting. Right. So realize realize that none of us have a crystal ball, and we just had the greatest 15, 16-month period of interest rates in the mortgage market that we've ever had. And I say for the mortgage market, not for you as a consumer. Obviously, the low rates were wonderful. But for us, rates never went up. You didn't have to lock a loan. I know a broker that literally didn't lock a loan and was doing 15-day locks on everything for the last year. And he looked like a genius. Well, now he has a bunch of clients right now that are either closing at 3/8 or 0.5% higher interest rate than he sold them on, or they're not closing at all because of the not having the loan locked. So this is the first time in a year and a half, 2 years that we're in a rising rate environment. So the question is, when do you need to close? If you need to close in the next 30 to 60 days, we just need to lock the rate. There's no sense in fighting what's going on, that the market wants to move higher. There should have been a correction of the sell-off when we went from 2.625 for really well-qualified conventional borrowers up to about 3.125. There should have been a correction. We should have got some of that back. It's never looked back. So when a market gets really bearish, in this instance, the bond market and interest rates moving higher, you don't fight that. You wait until we actually put in that bottom. So anyone in a short time frame of 30 to 60 days, just lock it and take the stress out of it. You may leave a little bit of money on the table, but I doubt that we're going to see a large improvement before the beginning to middle of summer. And why is that? If you watched any of the financial news today after the Fed statement, the smart commentators were pointing out, and actually Powell in his prepared remarks after the Fed announcement today, he said the Fed is not concerned about the monthly or the year-over-year inflation numbers. And the reason being is last year in March, when COVID jumped off, we actually saw a decrease in consumer prices. Like everything shut down. We had a really low number. Now, after 12 months, those March numbers that were really low last year roll out of those figures, and the new month of March 2021 is going to roll in. So we're going to see an increase in headline inflation. Next month, the same thing happens. Another really bad month rolls off, and a pretty good month rolls on. So we're going to see CPI figures, the Consumer Price Index, up at over 3% by June. So the market's held up pretty well today. And some of that was Powell pointing out the obvious, that The Fed said, we don't care what CPI says right now. We're trying to get long-term inflation up to 2%. We know it's going to be hotter than that over the next few months. Don't care. So hopefully the markets realize and don't care. There's just some other things in there. And just when you see hot inflation figures coming out, inflation is the enemy of bonds. It's a fixed income investment. When you say, I'm willing for 5 years, 10 years, 20 years, 30 years to take X rate of interest, just like you on your lock, they don't want to lock themselves into this low yield when rates are likely to go higher.
Right.
And right now, due to higher inflation, it looks like those yields are going to go higher. I don't think that's the case. By the end of the year, we're going to see inflation back well under 2%. And people are going to realize there's larger structural problems with the economy and all of the money that our government is spending right now that we don't have. It's interesting to say the government is spending. The government is borrowing to spend money they don't have. That has been proven long-term to be deflationary. People always thought it to be inflationary, but what it does is it pulls money away from productive purposes of building factories, getting jobs, things that actually do create inflation, that it slows growth. We have lower GDP going forward. It's going to be harder to generate growth. Combine that with the demographics of the United States, an aging population, more people out of the workforce. The thing that the Fed said today is their number one concern is unemployment. And they're not looking at the headline unemployment figure because it excludes all of the people who are detached from the workforce that would like to work, but they just gave up. They're not even looking. So their preferred figure is to say how many people are participating in the workforce. It's going to be a while. It's going to be 2, 3, 4 years before we get back anywhere near where we were at the beginning of 2020. So long way of saying, if you're a betting man, a gambling man, and you believe what I'm saying, if you're looking at closing at the end of summer, I think that rates will have moderated some. I know they're going to be under 4%. They could go up as high as 3.5, 3.75 before we get some moderation. If you're not a gambling man and you just want some certainty, you can look at those longer rate options, but they may quote you like a 3.75 or a 3.875 for a 180-day lock. So you may just look at it and go, I'll roll the dice. The biggest thing, Jeb, you and I have talked about this. What the government is doing with a federal deficit or a federal debt that's going to run to $30 trillion is they've maxed out their credit card. The difference between them and us is they have ways of manipulating the interest rate on their card. If you maxed out your card and you could control the interest rate, would you let rates go up? Of course you wouldn't. You'd keep them as low as possible because otherwise it might break your budget and you would be bankrupt. The government has no choice but to keep interest rates exceptionally low. So can we see a period of time where markets don't get that and don't understand that and they go up like they have recently? Absolutely. But over the long haul, they're going to moderate and be lower. I still believe we'll see rates lower than what we saw at the lowest point at the end of last year. So what does that tell us? It doesn't mean don't buy right now, because as rates move lower, that will continue to push home prices higher. So what it tells us is don't pay money for your loan. Just like we were saying last summer, don't pay 2 points to get a 2.875 interest rate to say I'm under 3 when we eventually got there for free. Don't pay 2 points to get a 3% instead of a 3.5 when do the no-cost loan at 3.5, and let's come back at the end of the year, at the end of 2022, and roll it down in a no-cost loan back under 3%.
All right. Yeah, I mean that's a lot of information to take in. If from asking whether or not you should lock your loan by the end of summer, but I think it's good information. I mean, if I watched the Fed statement this morning, I watched the highlights, and there's a lot of good information in there. And everybody thinks inflation right now is a problem, and they laid it out pretty clearly that inflation right now is not a problem. The inflation numbers year over year may look like a problem, as Josh mentioned a moment ago, but the reality is, we're not having inflationary issues at the moment. But we could in the future, just depending on what happens here. A couple of good questions to address here. Someone, I forget who, I think it was Michael again, actually asked a question about. So, right now, new construction is one of those hot markets just because people, well, in theory, you can buy something at a fixed price, not have to overbid, kind of know what you're getting, whatever. Well, a couple things have changed on that front. One is a lot of new construction builders right now are doing highest and best offers because these builders are now busy. They're overwhelmed because people are tired of playing the resale market. So now they're willing to go new construction in some cases. And now the builder's saying, you know what? Let's do this highest and best thing.
We want some of that action.
Yeah, we want to do that. And so now people, people would ask this 2 months ago or 3 months ago, and we would say, well, new construction is a good option because you know what the cost is going to be. They say it's at, the price is $725, and you're going to place $725 unless you do builder upgrades or what have you. Not the case anymore. Whole different situation there, but that's a different scenario in itself. But asking about an agent representing you in that case. So you can always go into new construction, just like you could go into a property at an open house and use the agent on site to represent you. New construction is one of those that, Josh has mentioned this before. Typically when you're buying a property in California or any state for that matter, a resale property, an existing house, you have a contract from the state, right? Your local board, if you will, has a contract that they use, or not your board, but your state, rather, your real estate department for the state has a contract that everyone uses. It's all the same language. Everything is template for the most part, outside of, price and all that good stuff. New construction has their own contract. And if you thought, state of California's normal disclosures were out of control, go buy a new construction property. These contracts are 100 pages long. And the reason I bring that up is because their contract, the residential purchase agreement, let's say California, for example, is there to help both buyers and sellers. It's there to make sure that both parties get a fair deal. Both parties are taken care of equally, that not one party is favored over the other, so on and so forth. Contractors, new construction, those contracts are written to protect the builder. No question aside. So you need an agent on your side to help ask the right questions, to make sure that there's some representation there, because it's very easy to get taken advantage of in these situations when you don't ask the right questions. And I can't tell you how often in these meetings and meeting at new construction, you can actually get them to reduce the price. You can get them to do certain things by just asking for it. And it's good to have someone there that knows that side of things and can guide you through that process. So, also the loan was approved through automatic underwriting. Is that any better? So, we already approved through a lender. So, what's going to happen? You're going to go into the builder. The builder's going to make you cross-qualify with their lender. Their lender is going to offer you incentives to use them, builder upgrades, etc., to use them. The builder wants control. They want their lender to do it. That lender wants the loan, so on and so forth. So I would tell you that, just because you have a pre-approval doesn't make you better off, but they're going to make you cross-qualify. So just know that going in advance. Anything you want to add to that, Josh?
No, I would just say the whole buying new construction from our end, from the mortgage professional, from the real estate professional, it's spectacularly annoying. It doesn't mean that it's bad for you. We talk about it because it can be a really good option for you as a buyer. It's annoying because they will make every effort to say, oh, you're registered on our website, you can't have representation. Oh, you walked into the open house, you can't have representation. But then, like Jeb said, they give you a 120-page contract. So I have a buyer right now. She walked in, so she couldn't have representation. She already registered with them. They had her on record there. And so I've been getting to explain a 120-page contract. Not my job. I don't get paid for it. I like her. She's done a lot of business with us. Her dad recommended her to use us. So we're going to go above and beyond. But it's unpleasant to have to do extra work when you should have someone that's fully dedicated to it. And I'm unique among loan officers in that I have not only have a broker's license, some lenders have a broker's license set up as a broker shop, but I've represented myself in over 40 real estate transactions. I've invested for over 20 years. So I do have insight. Most loan officers couldn't help you, even if they wanted to, in that situation. The flip side is on the loan. Jeb was 100% on point. The builder wants control. So they are not going to make you use a lender that has horrific terms, because they truly want you to close with their lender so they know all the way up to the very end what's going on in that situation. But what I can say is they always play games with everything. It's, we're going to give you a magical $10,000 design center concession if you use our lender. knowing that they have $20,000 in markups on what you're going to do at the design center. So they gave you back half of your own money so that you'll use their lender. Or they'll say, hey, we're going to give you a $5,000 closing cost credit. And you look and their closing costs are $8,000 higher. So it's just an annoying game. The same client who we've been walking through the 120-page contract, we also have to deal with the builder's lender that she cross-qualified with, calling every couple of weeks. Hey, did you change your mind? Hey, we'd like to do this for you. What if we give you an $11,000 design center concession? So it's just a silly game. They're not there to help you. They are there to close the deal for the builder. My job is dependent on you coming back to me for 5 loans over the next 25 years. Their job is dependent on that builder bringing 25 loans in the door next month. So never lose sight of the fact that they do not work for you. Yes, they want to close you and they can't upset you because then that could disrupt their relationship with the builder, but they are 200% there for the builder, and any good service or good result for you is just a byproduct of them trying to make the builder happy.
Well said. Good stuff. Al's asking another good question here, and I kind of addressed this a moment ago while you were gone, Josh. So how often do buyers offer 20% down, switch to 5% down after acceptance? Can seller cancel? Yes. So what happens is when you sign a contract based on the amount of money that you're putting down, if you change those terms, the seller has to agree to those terms. There has to be an amendment made. Both parties have to agree to it. If they don't, you're essentially in violation of your contract. And in theory, yes, the seller could cancel. They could give you a notice to perform. If you don't perform based on whatever it is that you're not doing or doing per the contract, they could cancel. So yeah, it wouldn't be a good practice. It's not ethical for one, but it's not good business practice to say that you're going to go in with 20% down and then end up in the scenario I used earlier, doing a conventional loan. And the second part of your question, how often do I see it? I don't see it. I've seen scenarios where people came in with cash offers and wanted to change them to loans throughout the transaction, and then we've done that in the past. Sometimes we say, hey, no, this is, based on the time frame, this is what you said you were going to do. People have still closed. So I wouldn't say that it happens often, but I'm assuming it does happen, especially in the market that we're in, but I haven't seen it. So
Jeb, I have one right now. Let me walk you through the mechanics of it. It is definitely an ethically gray area. Maybe not even gray. You should not do it. But let me tell you how it worked out in our situation. Client's buying a $1.4 million property up in LA. Property needs work. So we look at it. He wrote his offer as 20% down jumbo financing, and he could do that. We looked at 10% down jumbo financing so that he could write it as what he was actually going to get. And the 10% jumbo was awful. We could structure it as a conventional first mortgage with a big HELOC with it, and do it 10% down. So I knew this is what he wanted to do because it preserved $140,000 to do upgrades to the property. And we explained to him up front. I said, we almost need to do dual tracks here and have both approvals for you. They can cancel on you. If I send over docs over for a 10% down, they can go, this isn't what we agreed to, and they can pitch you out on your ear. And in this instance, just super hot LA market, they actually had higher offers that came in after they had closed the bidding, essentially. So it's kind of surprising that they didn't, other than it's a bunch of errors and they know we're going to close next Tuesday. So they're like, yeah, let's go ahead and close it. But just long way of saying in that, we were prepared to do the 20% down. We absolutely wanted to do the 10% down. We delivered docs, escrow got them. No one said a word, because at the end of the day, the financing makes no difference to the seller. You did do a bait and switch on them, but when you're a week from closing and the loan docs are there, I have never in my life, if this happened maybe 5 times in 25 years of doing this, seen a seller go, you're out. You misled me. I would avoid it at all costs, but if you feel like it's your only option, be aware of the risks on the way in, and hope that it doesn't upset any relationship. And we've talked about this. One of the most important things I have is my relationship with the community of realtors and buyers. I have a reputation, and that reputation is important. When Jeb writes an offer and I call that agent, hopefully I know them. Hopefully they know me, and they know people who've done business with me. And they're like, okay, Jeb's on point. Josh is on point. I don't know anyone else around here. I'm going that route. So doing this stuff is not good for anyone. sometimes it's a necessary evil.
Nope. Good. Banksy's asking a question. Even after foreclosures and more surplus of properties hit the market, when do you think supply will exceed demand? Asking about quarter of 2022, maybe. It's a good question. I don't think you're going to see it in 2022. I think you got a couple of years before supply actually exceeds demand. I think if anything, you get a more balanced market from foreclosures and evictions. And I don't think evictions even really play that big of a part, but foreclosures, and that can has been punted. It is still in the air and is going down a field that is a couple miles long. So that we don't know when that's going to end. It's going to take, we've talked about this so many times. I feel like I just repeat myself often. It's going to take so long for the court system, at least in California, to go through these foreclosures. When I sold foreclosures back in the day from 2008 to 2012 or 2009 to 2012, some of these foreclosures that I sold in 2012 and 13, these people had been in the property for 3 years, 4 years, just fighting it. And guess what happens when foreclosures start to happen? Attorneys start to get involved. You start to get these companies that represent you and want to work on your behalf to delay the process and so on and so forth. And guess what? This time it's going to happen again. And you're going to have these people trying to work with lenders to delay and so on and so forth. So the idea that anyone thinks that you're going to have all of this property hit the market at one time isn't reasonable. I mean, you need something like 3 million properties to hit the market to even come to like balance terms, not even to become a buyer's market. And that isn't going to happen anytime soon. I don't know. Yeah.
Put it into numbers. Cause I just had this conversation with a buyer, came from the channel here, talked to her, and she's going to be buying through you. And she was saying, well, what do you think? When basically this exact question, I said, let's put it in simple terms. Right now, depending on the measure you look at, we have 1 to 1.5 months of supply. A balanced market is somewhere between 6 and 7. So we have 25% of the homes available for sale required to get to a balanced market, not a buyer's market, a balanced market. Right. So we would need 4 times as many homes to come on the market, or 2 times as many homes and half of our buyers to disappear, which you and I know is not the case. There's more buyers coming out day after day. So assuming demand stays relatively stable, we need 4 times more homes to get to a balanced market. Could I hope possibly see towards the end of the year, we get to maybe 3 months supply? So we have 4 and 5 offers on a home instead of 20. Yeah. Does that in any way get you to anything under what a reasonable list price, a reasonably priced home lists for? No, it doesn't. So how do we get there? You tell me. So to get to a balanced market of 6 to 7 months supply, you need either demand to tail off or a massive amount of supply to come to market. One of the numbers that you and I talked about, and you put in a video a couple of weeks ago, is if someone last March took forbearance on the day that they offered it and hadn't made a payment until today on a $500,000 house, they are about $20,000 behind in payments. Isn't that what we figured? But they
give or take, right?
But they had gained about $30,000 or $35,000 in equity. So assuming they really needed forbearance and they still couldn't make the payment, and forbearance now goes away, they put it on the market and they net more from the sale than they did last March. So anyone dreaming that there's a volume of forbearance properties that are going to end up coming on the market and going to foreclosure that's going to lead to additional supply, first of all, it's a minuscule amount of homes. And it's way into the future, just like you said. Just to put it in a context, there was a house on Main Street here that got lost in the last downturn. I followed it. I called every asset manager that had it under control over the 12 years that it took the bank to be able to resell the home. 12 years. That's an extreme case. I don't know of one any longer, but after 12 years, the bank finally won in court and got their right to sell. And it was good for them. The house sat vacant for 12 years and they ended up selling it for probably 3 times more than it would have sold for at the bottom of the market. So there's nothing demographically going on. There's nothing economically going on. Even if we hit a big recession in 2022, what is worse than what we had last year? It's just, it doesn't take a bunch of buyers out of the market, and a recession would push rates again. It would feed into our model that you have a 2.5, 2.25, 30-year fixed rate. Lots of people willing to step into high demand markets.
No, absolutely. Agree. Agree. And then I got some people here talking about short sale, waiting for the short sale festival to come soon. I hope you got some patience, Carlos. It ain't coming soon, my friend. More equity in properties than people have ever had in the history of owning property. It's going
to
to be a while.
short sale, you by definition have to be upside down. No one is upside down. The people that bought homes last June are up 12 and 15%, and they made somewhere between a 5 and 20% down payment. They have a ton of equity in the property. Jeb, I don't know if you showed this one while I was out, but let me throw this up here. Lalacia Dove.
Yeah.
Yep. Let me throw in on this. I've done 203Ks back when they used to be available for investors. I did them for myself to buy properties and renovate. After the fact, I've done them for myself and for other people. To this day, I have a good friend that's his specialty. That's his wheelhouse. The one a year that might come across to me, I say, why don't you talk to my buddy Scott? He's awesome. He does 10 of these a month. Do you want me to fumble my way through fixing it? I'm a great loan officer, but do you want me to fumble my way through figuring out a 203K? Or do you want Scott that knows these like the back of his hand and might know a better way of accomplishing what you want to do? I've got a buddy on the East Coast that covers 30 states on the East Coast. Scott and Jeff actually work together. These guys crush this stuff. If anyone comes across my desk, I say, I'd love to do the loan for you. I'd love for you to be my client. I'm going to send you over there. And thankfully, both of those guys, if it's someone in California, they'll do the loan for them. And they say, hey, once we do this, just remember, Josh is your guy. So it's a unique beast. Are they that difficult? Are they that hard? No. But let's realize that 90% of loan officers can't hardly handle a VA IRRRL that doesn't require income documentation. So throw them something complex like a 203K, and you're just asking for issues or troubles.
All right. So I got some clarification on Pogimoto's question earlier about what is a Hubbard clause? And I wasn't familiar with a Hubbard clause either, referring it as a Hubbard clause. So I just Googled it real quick. And it's essentially, it's a contingency that allows a buyer to buy a property with essentially the idea that they're going to sell their property. And so the question is, how often do sellers and buyers put those in a contract? Right now, pretty often, because you got a lot of buyers in this market looking to purchase property that, whoa, you good over there?
Yeah.
Looking to purchase property and they haven't sold their property because, you're in a market where there's not a lot of inventory, right? So buyers buyers, sellers, however you want to, sellers that are buyers are looking at inventory going, you know what? I don't want to sell my house until I find something to buy. Kind of similar situation where I am. But I'm often seeing properties come up and I'm like, looks like a property I could buy. And in that case, I would have to sell my property in order to purchase that property. And so in that case, that would be a Hubbard clause, I guess, based on that, where we use them. They're different here in California. We don't refer them as that, but that's essentially what it is. And to answer the question, yeah, they're very, very common in this market. A little harder to get accepted unless that buyer's property is in escrow already. And not only in escrow, but in the process of contingencies being removed, so on and so forth. So just know that if you're a seller who is a buyer, don't wait until you need to, till you find the perfect home to call your agent and say, I'm looking to sell my property, because that happened to me 6 months ago, Josh, on 2 transactions. And honestly, the sketchiest transaction I've done in probably 10 years. And I can't believe it closed. I mean, 1,000%, I cannot believe it. Like, everything had to match up perfectly for that to close. And now that I look back on it and I think, wow, they were the geniuses in this whole thing, because I mean, that same property today is probably $100,000 more. But nevertheless, things seem to work out. All right. What do we got here? Josh, anyone sticking out?
I had one, and darn it all, if I didn't move past it, and now I can't find it.
So you got some props coming in from Dwayne Scott. He says he does loans. Josh, what lender do you use to broker loans? He gave you some props earlier in the show as well.
Let's put that part up there. Why are we putting boring questions like what?
Oh, well, we'll go to that first. He's
There
a loan
we
officer
go.
here in Southern California. He's asking the questions about, what lender you use to broker your loans.
So I would say we have a rotation of about 5. In general, the number that gets thrown about is there's 200 wholesale lenders in the country. There's probably more than that because there's local regional banks, but 200 national wholesale lenders that a broker can choose to send your loan to. We're approved with about 25. We use a program called Loan Sifter that compares pricing of all 200, shows us what's available and what's out there. On any given day, there's some lenders that are off the wall, crazy lenders that have spectacular pricing. They also have terrible reputations and awful service, so we wouldn't put your loan there. So our job is to go through there and find who that has awesome service and is good during the process and post-closing, because that's going to be your lender that we place you with. Who among those has the best terms for you? And for us, we use United Wholesale Mortgage. We don't use them a lot. They come in and out of the market. For the better part of the last year, their terms were not competitive. Their turn times and their service are amazing. Their terms were not competitive. Well, about a week ago, they've gotten into a little bit of a battle with Quicken, who also does wholesale. And they both are getting really aggressive on their pricing. So in the last week, almost everything has gone to United Wholesale. Prior to that, very little went there. We have a very good relationship with Finance of America Mortgage. Again, a big national wholesaler. They have every product under the sun. They can help all of our clients. And again, they come and go out of the market. Last July, we sent them 90% of our business. And then in August, they got backed up and slowed down. We sent them 0% of our business. So those are the two big ones. HomePoint is also a big one that we like to use. HomePoint is pretty vanilla. Again, they cover everything. They have pretty good service. They have really good terms on high balance stuff. So for us in California, Southern California, where there's a lot of high balance conforming loans above the 544 level, they have just been killing it on that pricing. So really, it's a case by case. We don't get locked into one lender. We have a handful of about 5 that we're very comfortable with. And if one of those is close to the best in pricing, they're going to get the deal.
Very good. So I was able to scroll up and find a couple of good questions here that I think are worth addressing. So I'll let you pronounce his last name, Shumulatrov. He's asking, what do you think about new rules to take mortgage to buy a second investment property? So I'm assuming he's talking about the new Fannie Mae, Freddie Mac. Was it Freddie Mac involved in that now? Fannie Mae, okay, so Fannie Mae guidelines that they can't sell more than 7% of their loans, so on and so forth. So what are your thoughts on, I think some lenders, as last Friday had talked and mentioned they had already raised some pricing to take this into account, but I'll let you address this one real quick. Maybe explain a bit about what it is before going into it.
In general, what they said is that lenders cannot make more than 7% of their loans to non-primary residence borrowers, so investment properties and second homes. And across the board, it looks like about an additional 1 point hit for any of those properties. So most people don't pay the extra point. They never pay it out of cash at closing. Some do, but very rarely. So what does 1 point mean? It means your rate is about 0.25% higher if you're buying an investment property or a second home. And the purpose of any loan level price adjustments historically has been to compensate the lender for the additional risk. Is it slightly more risky to do a second home? Well, historically, no. And the data has never borne that out. They have larger down payment requirements. So there's never been any additional risk. So now we're just charging an extra point to essentially make sure that Fannie and Freddie do not do a large proportion of these loans. So they're trying to make the private market, your local bank, a credit union, be more competitive on those and push that production off to them. Essentially, although Fannie and Freddie are not government agencies, they're quasi-government agencies. They have an implied government guarantee. They were taken over by the government, so they essentially do have the government guarantee. They're trying to privatize them, trying to make them have less of a role in the mortgage market. And there was a lot of momentum in the Trump administration for that to happen. And then COVID happened. And if it were not for Fannie and Freddie's large presence in the market, we would have had a big problem in the mortgage markets last year. Everyone that got to refi at ultra low rates is because Fannie and Freddie were big in the market. So again, I don't think we should be pricing loans based off of we want to make only certain loans, 93% of them come in as owner occupied. We should be pricing them based off of the risk. If Fannie and Freddie are businesses and their goal is to be there to serve the market and make a profit doing so, you shouldn't disincentivize good producing loans. So it's unfortunate. Essentially now, if you're a homeowner, you want to buy a second home, you're going to pay 0.25% higher interest rate than you would on your primary residence, which again, is that the biggest thing? Someone going to cry someone a river? Hey, you got to buy a second home. You have one and you get to buy a second home. And we should cry for you that you have to pay 0.25% higher rate. It's kind of silly to say that. But at the same time, why? Is there really more risk there? Have we shown that over time? And that 1% is regardless. You could put 10% down, which is your minimum on the second home. You could put 50% down. You're paying a point. Are those the same level of risk? No, they're not. I mean, I could see if you wanted this minimum down 10, 15, 20% on the second home, pay a point. But the other loans, it's kind of silly. It's everything that Washington, D.C. pushes out to us in the mortgage industry is silly. It's politicians thinking they're making points or scoring points for their constituencies, and it doesn't. No, thank you. It doesn't actually translate and come down to the ground level mortgage market the way that it should. There are so many absurdities in our guidelines that came about because someone in Washington, D.C. said, well, that's not quite the way we want it to work. Do this. And they don't think it all the way through. Like when I say that, my favorite example is to say that when COVID jumped off. When the market first tanked in 2008, the government came out and said, hey, there's no jumbo market. We will do Fannie Mae, Freddie Mac, FHA loans up to 729, 750. And within about a year, they said that was an emergency thing. We're coming and going to moderate that. And they made it 625.5. So at that time, there were FHA loans on the books between 625.5 and 729, 750 that they didn't have anywhere to refinance. So they said, we'll grandfather those in, we'll do those loans. But instead of a 0.85 monthly mortgage insurance, they need to pay 1.05. So they pay 0.2% more in mortgage insurance. But they never inflation indexed that to say when loan limits got higher, then there's not this premium. So now we can do loans. I always forget what exactly the number is. 822,375 you can go up to, well above the 729, 750. But if you're above 622.5, which has not meant anything to the mortgage industry in years, you pay more in monthly mortgage insurance. And you're like, why? Why? It's because there's idiots in Washington, D.C. that don't know anything that are writing mortgage regulations.
All right. There you go. You have it. Got some opinion there. Yeah. We're going to take a couple questions that are short to keep this thing moving along here. If you're watching and you haven't already, do us both a favor. Hit that like button. It helps us out. And if you haven't subscribed, that would help me as well. I'm looking to grow and educate and help homeowners. So got a good question here from Samuel. He's in California. He's asking, does a bigger down payment have a better chance of getting an offer accepted? Now, I think this could apply to anywhere outside of California as well. And the answer is yes. I'm finding that in this market that this is tough. It's not tough to say, but it's one of those things. Most listing agents don't understand financing. And so they automatically assume the guy with the biggest down payment is the most qualified, when often that's not the case. And so what people do, sellers do, agents do, is they look at the person, putting the most money down, the highest offer, and that's their seller or their buyer rather, versus going through the ins and outs, asking the right questions and what have you. So in this market where people are getting multiple offers and what have you, I think putting a large down payment definitely helps, but it also has to be paired with, the right price, right? So you need both the right price, in some cases the highest price, along with the large down payment. Now, I put an offer in for a client last week, and the owner was an old loan officer. He did loans at some point, 18 years or something, and he wanted somebody with a big down payment. That was his thing. I was talking to his agent. He wanted a buyer that had a large down payment. And so my conversation, in fact, I knew the agent on the other side. And so my conversation with the agent on the other side is, this guy was a loan officer. He should know that the guy with the largest down payment doesn't necessarily mean he's the most qualified. Whatever. So, but it's perception. Perception's reality, especially in this market. So if you have the down payment to put down, it may be worth it in this market to use it, because it's a tough market. And if you can do anything to help stand out, I would say do it.
Let me throw this and give a little color to that. I have a client right now. multiple bidding situation. There was 4 offers over 820. They wanted 827.5. Appraisal comes in at 770. I want to say it's a terrible appraisal, but there's something unique about this property that under the appraisal guidelines, the appraisers do not have a choice but to use one of the comps they use and weight it most heavily. So what we did is ask the buyer, I said, I'll eat the cost of that first appraisal. Will you pay for another one? We can't do it with the same lender. We have to move it to a different lender, order another appraisal. And if it comes in low, then the seller is going to realize that wasn't just an idiot appraiser. That's literally what he has to do. So the second one comes in at 780. So now we're sitting here saying, okay, that's $47,000 less than the seller was expecting to get. And what had happened, there was a 5th offer that came in after the fact. That one was $200,000 down, and it was contingent. So she didn't want to take it because she didn't want to wait and hope that their home sold. But now their home has sold. So now we're my buyers don't have $47,000 to make up the shortage. There's now someone with $200,000 cash in hand says they'll waive the appraisal. So we had a big negotiation, and among everyone, we got the sellers up to 803, and they were willing to accept that. And in that instance, they made that decision of, I could wait another 3 to 4 weeks and hope these people are good for their word and are willing to make up the difference, because they did need financing. They were going to get an appraisal, and it was likely to come in at the same level. And we were lucky. The sellers agreed, let's just get it done. If you can close it next week, we're good. So that's kind of where it comes into play. Jeb, again, as another viewer here from the channel that I got approved today, we had the conversation, and she's like, do I even want to get out there and shop right now? I mean, there's so many people, there's 50 offers on a property. I said, well, the one thing you have in your pocket is you are 20% down. You're extremely well qualified and you have 20% down. So relative to someone equally well qualified as you with a 5% down or a 10% down, your deal doesn't die if an appraisal comes in low. You can choose to do that. Now you no longer have 20% down, you have less than that, but you have the money to make up the difference. You just have to choose whether you want to close with mortgage insurance on the transaction. So it does. It makes a difference. It makes there more options if and when an appraisal comes in low.
No, and actually you were gone, and we had discussed the question where that exactly, you put 25% down, you get into it, the appraisal comes in less. Can you change your offer to 20% down and use that 5% towards it, and so on and so forth? So if you want to hear that question, if you're just now joining us, you can go back and check that one out too. It's towards the beginning.
I'm going to have to not check out during the middle of the show, Jim.
I know the good questions were answered. I cherry picked them.
I see.
So Douglas Nickerson's asking, he owns a current home that is rented out. He's looking to purchase a new home to be his primary. Would it have to be considered a second investment house? No, it would be a primary residence. If you plan on living in that property, that would be your primary. The first home that is rented out would clearly be the investment property. And then the lender, would use 75% of those rents to help you qualify, so on and so forth. So that's a different question, but that should give you an idea. So here's Jorge is asking another question here. What do you recommend if your house is paid off and I want to pull cash to buy another home, all cash out refi or HELOC? So property's paid in full. Yeah,
the answer is beauty's in the eye of the beholder. There's not a wrong answer. So look at pros and cons of each. To me, the answer is 99% of the time, do the cash out refinance. And the reason is the HELOC is a variable interest rate, and post crash, even the best terms on that are not all that good. So prime's at 3.25 right now. Prior to the crash, we would have things like you could get a loan. I did a HELOC for my dad prior to the crash that was prime minus 0.5%. So it's 2.75%. You're like, that's fantastic. I like that. Now, even the best qualified borrowers are prime plus 3/4. So you're looking somewhere around 4% on that. You say, well, I can do a cash out. Even with the spike in rates at 3.5, I have a fixed rate. I know what my payment is. I don't have to worry about this interest only payment for 10 years and then a repayment period of 15 or 20 years and the payment spiking. And the other thing to remember is people always say, well, I want that HELOC just as security there in case the market goes south again. Well, when the market went south, every one of those HELOCs got shut off. Right. Just cancel. Yeah. Hey, cool. You have a HELOC.
That even happened during this deal. Didn't Chase at the beginning of the pandemic come in and basically cut off all the second loans and the HELOCs at that time?
Yeah.
Yeah, they're gonna mitigate risk if it means canceling that. So
Yeah. So long way of saying I almost always lean towards taking the cash out. Run the numbers. No, to me, I always say the answer is numbers never lie. Do a side-by-side comparison, list out the pros and the cons, and you decide what is best for you. I get this question all the time whenever I pencil the numbers out. 99 times out of 100, they go, yeah, let's do the cash out.
All right. So Paolo is asking a question. We are closing on our second house, but we overbid on the offer. If appraisal comes in lower, what are my options, ethically speaking? So I did a video on this yesterday where I talked about this, and now you want to check it out, and you'll get more detail in that than I'm going to give here. But in theory, assumed you haven't waived your appraisal contingency, you got a couple of different options. In some of them, you still have if you have waived it, but one is you negotiate with the seller. You try to get, them to either lower the price down to what the appraised value is, or find a number somewhere in the middle, split the difference, if you will, and you guys both walk away and get the transaction closed. The other option is that you make up the difference. You come in with the cash of, the percent that you're financing of the difference to cover that. Third, you walk away. You decide, hey, look, I'm not going to buy a property where the appraisal didn't come in. Those are really your options. Now, if you've waived the appraisal contingency, you can't use the appraisal to back out. Doesn't mean you can't go back and ask them to try to negotiate, because you can. The likelihood of them doing that's not very high, but again, sellers want to close transactions. So depending on how much that thing's off, people might be willing to negotiate. So you might have a little bit of leverage there if you're 10 days into a transaction and they have some sort of pressure to get something closed on the other side or whatever. You don't know people's stories, but that could be an option for you. And then the other option is if you have to make up the difference, right? And if you can't, then you're in violation of the contract, and so on and so forth. So there's other repercussions if that happens. So hopefully.
Jeb, it reminds me of the old Chris Rock bit that a man is only as faithful as his options. So a seller in that situation, what are my options? If it comes in low and you were the only bidder, then you're going to go, hey, I'll pay what the appraised value is. The only ethical question here is exactly what Jeb said. Did you waive the appraisal contingency? Other than that, it's not ethical. It's just facts. What can everyone do in this situation? So a seller that has 25 offers, we just talked about the same exact situation here. The one, my seller in that situation has a higher netting offer that doesn't need the appraisal contingency. They chose to meet us in the middle because it was the more sure thing and the faster path to getting paid. So that's why I say a seller is going to be as flexible as their options. If they had some amazing other offers, maybe one that popped up after they accepted yours, they're not going to be super willing to be flexible on that. If they don't have a lot of options, they might be incredibly accommodating.
I just got a text message from an agent that I'm trying to do a deal with here as I'm on the phone. And his text says, my client asked me if you were the type of agent that answers their phone. And he says, guess not, because he's calling and I'm on this and not picking up my phone. So I wanted to text him back to let him know that this is a rare situation.
Tell him I always answer other than when I'm live on the internet talking to people.
Yeah, too good. All right. So Paul's asking a question here. Is it worth it to refine right now to switch an FHA jumbo to a conventional, lower PMI payments rather, but a little higher rate? Current interest rate on my loan is 3 1/8. So Paul, maybe you can comment below loan amount. Well, you said FHA jumbo, so I guess we can get an idea of what that is. But credit score is going to play a factor in there. So maybe throw that in there, and then Josh can give you an idea.
Here's the thing. Other things being equal, again, numbers never lie. We just need a side-by-side comparison. There's more things to. So with the FHA, whatever your interest rate is, it's your interest rate plus your mortgage insurance, because that mortgage insurance is never going away. So take the 0.85, which is most likely what you're at. You might be at 1.05. Add that to your interest rate, and that is effectively your interest rate. It never goes away. So 3.125 could be spectacular, or you're saying 3.125 is the current. If you're 3.125 plus 0.85, you're up at like 3.9. A 3.5% refinance without the mortgage insurance crushes it 8 days a week. So really, this question should have been answered if you're already in the process with someone. They should have been able to pencil out those numbers and show you, here's what you have, here's what we can do. What does it look like? Other things come into play, and what does that loan cost? Your current loan cost you nothing. You already paid for it. What does the new loan cost? Are we adding anything to your loan balance? And are we starting back over at 30 years? Or do we want to look at, hey, you're 3 years into that. We want to look at a 27-year option. These are really important things. I'm pretty adamant that I don't have to impose my will on you of what's right or wrong in your situation.
So 635 loan amount, 720 credit score.
Okay. So we've used this number here before. So we always say, when does it make sense to refinance your property? It's you have to save enough in interest to beat the number of 125,000 divided by your loan amount. So in this situation, 635,000. So we need to be about 0.20 better. So if we're anywhere in that 3.5, 3.625 range on the new loan, it absolutely makes sense. The only questions we need to answer is, what does it cost, and are we starting back over? What I was saying is, I have a feeling on what we should be doing for your loan. Everyone should be working from day one of my loan to 30 years later owning a home free and clear. We all want to retire. We all want to be financially secure. The best way we can do that is to secure your housing expense as low as possible, which is zero for the mortgage, and then you're just paying your taxes and insurance. So I always want to show you that option when we're looking at a refinance. Can we keep it at the same loan term? Can we shorten the loan term and still lower your payment? In this instance, I would say those numbers are like no-brainer. We would absolutely want to do that, but the best way to determine it is to pencil it out. Once we determine, yes, this is the right thing to do, now do we want to start back over at 30 years? Do we want to match the term? Do we want to do a no-cost loan? Do we want to roll costs into the loan? That's the question we have when someone's looking at refinancing. And what I find, the giant call centers, they don't do this. They just tell you, hey, we can get this amazing low rate today, and here's what your new payment is. Well, cool. That could be the worst thing in the world for you. You need to look at all of those options and see what your long-term plans are.
Awesome. And if you guys need a lender in California, you need one across the United States, I often tell you guys this, reach out. You guys can come to me directly. You can email me. You can, message me on IG. In fact, I put a link on my website recently where people can go and actually put in the information, because it asks the questions that I'm going to ask you anyway. And that is my name. So jebsmith.net /referral. If you go there, you can fill out that link and I'll refer you to a mortgage professional or a realtor across the United States that does a stand-up job. Ethical, good people, and we'll take care of you. So that answers that. Let's see here. What do we got? I saw another one here from earlier that I wanted to touch on, but if you got something, pop it up.
I thought I did, and I cannot remember where it went.
So where is it? That's a good question.
This, again, there's reasons to kind of avoid this question, but let's throw it out there while you're looking for something. So Salvador Marquez asks, anything new on Biden offering a first-time buyer incentive? Okay. And Jennifer, our wonderful moderator, stepped in and said, hey, buyers don't need incentives. There's too much competition right now. That's 100% correct.
Right.
Jeb, I told you about this a little earlier today. One of the financial experts that I follow, his newsletter this last weekend was complaining about how CPI measures inflation, and it's flawed because it uses not home prices, it uses owner equivalent rents. So without going down that rabbit hole of what the difference is, I responded to him and said, you're kind of off base here, because owner's equivalent rents are better than the price of homes, because in any given point in time, about 65% of Americans own their home. Home tenure, the time that people are in their homes, is over 10 years right now. So in any given year, only about 6% of Americans are in the market for a new home. Only 40% of those, or about 2%, are first-time buyers. First-time buyers absolutely feel this rise in home prices, but rates are low, so it mitigates the increase in the actual housing expense. So where I was going with this is what ultra-high home prices does do, and what the government would be right to step in and incentivize or help people get in, we talk about this debate of inequity in the United States. We have people of color have less wealth than white people. There's not a more sensitive way of saying it, but that's reality. And you say, why is that? Well, white Americans are generally 75% are homeowners. So if we say the national average is 64%, we have much less non-white home ownership. And when we say that's one of the greatest builders of wealth, because homeowners have 44 times greater net worth, 61% of that net worth is in home equity, we can see that building wealth and financial security is largely dependent on a home. Now, if we're in LA and you're in Compton and an entry-level home is $600,000 now, you can do an FHA loan on that. That's 3.5% down. So you need $21,000. If there's any closing costs, you need $7,000, $8,000, $10,000. You need to save about $30,000. The average hardworking American in Los Angeles County has a hard time saving $30,000. It's an expensive place to live. So if we can find a way to incentivize or help bridge that gap, it's not, the $15,000. I saw a number that was published today that a $15,000 home buyer incentive would cover all of the down payment in 40 of the 50 most expensive metros in the United States, most populated metros in the United States. You're like, okay, so we would help people get in. So it's a good thing to do. It's the absolute wrong time to do it. If the market's already too hot and because of artificially low interest rates, the government has pushed home prices up. If you start giving away down payments, it's going to push them even higher. It's the right thing to do. I don't know what it looks like. I don't know how many of you have read too deeply into the 1.9 trillion that got passed, but they have verbiage in there that is laying the groundwork for that $15,000 tax incentive. And there's verbiage in there that you would have to be not only a first-time home buyer, but that your parents could not have owned a home. So you start getting into some really murky political areas there, because what are they trying to do? If we say that 75% of white Americans own their homes, we're trying to remove those people from being able to. So again, if we have inequality going one way, that things have favored white people, I'm not against favoring other people to try and level the tide. We just have to be really careful. Other things being equal, I don't like the government being the finger on the scales in different directions. Every time they've got involved, it screws things up. And I'm not talking about racial issues. I'm talking about the government manipulating interest rates. They first really got heavy into this in the late 90s when the tech bubble. And since then, we have never had real interest rates. The market has not determined interest rates for the last 21, 22 years. The government has. And we have stocks way too highly valued, and we have homes way too highly valued. And yet we talk about things in terms of racial justice, which the best thing we could have done is not overly inflate assets that are largely held by non-people of color. So long rant, different discussion. But I don't think we're going to see that $15,000 incentive anytime soon, but I think there's definitely pressure for it. And I would be in favor of it when the market dips. If you have a dip that you can mitigate a dropout in the market and help anyone who doesn't own a home get into the market and start building wealth, it's a good thing.
No, yeah, my answer would have been like 30 seconds. And I think the elephant in the room here is that you pay for a newsletter where a guy sends it to you and then you wrote him back and told him he was wrong. That's great.
No, I told him largely he was right. His conclusions were correct. The way he got there was wrong. It's what I do, Jeb. It's what I do.
So Pogimoto, he's been a star tonight, is asking another question here that I think is good. Is it sketchy if your realtor and the listing agent work for the same broker when you want to find a home? Will it conflict the negotiation? No, typically not, right? I mean, here's the thing: is you take the biggest brokers in the United States, if you will. Your Coldwell Bankers, your Keller Williams, your Remaxes, those guys, right? There's a lot of people that work for them. So often or not, you might be on the other side of a transaction on one of them where you have the same broker, because a lot of times one broker owns multiple offices or manages multiple offices. And, here in Southern California, those offices might have 300-400 people in an office. And then you take, 7 or 10 of those offices. So there's maybe a couple thousand people within them. So yeah, there could be an agent represented by the same broker on the other side. Often enough, and often enough, we don't even know those people. We might be in the same county per se, but I come across people with Coldwell Banker all the time that I have no idea who they are. We work for the same broker, but there's no relationship there. On the other side of that question, could it in some ways? Sure. I mean, it's just like two buddies meeting and we know each other and there's somebody on. You could have issues there, but typically not. I mean, most agents are good people. Good agents are, ethical people and will do the right thing by their clients. So I would say it shouldn't be an issue. All right.
There's a good one here from Nicole. My tenants are paying me with money orders. Is that an issue when underwriting the rental income for later on when using this income to qualify for another loan? And the answer is 100% no, because how they pay you, no one is going to take into account. How you report it to the government is how they're going to take it into account. So they're going to look at your Schedule E on your tax return, as long as it's been on the most recent tax return, preferably the most recent 2 tax returns. And they're going to do an analysis both of the rental income that you're declaring to the government and all of your expenses. So pretty short term there. A short answer is that it doesn't matter how they pay. If they handed you cash, it doesn't matter. It would only matter if you failed to declare to the government that they were paying you that cash.
Right. Good stuff. I'm afraid to
I'm
say
getting
that.
I'm getting on Fiverr first thing in the morning, and I'm getting the little outline of Jeb's head with a big good stuff exclamation.
We're going to sell it? Merchandise?
I don't even care. I'm going to wear it. I'm going to get one of those tight little t-shirts and just wear it around town.
That's fantastic. Nobody would know who the hell I was.
No, it's going to be awesome. Like, is that Jeb? Is that Jeb Smith on your t-shirt?
I'm looking for some questions here, guys. So sorry. Looking for something that's going to benefit you. If you have a question, put it in there. We'll be here for at least another 10 minutes or so, 5-10 minutes. If there's good questions.
Jeb needs another St. Paddy's Day beer because he's emptied the others.
Yeah. No, I still got one left over here. Hey, I'll ask a favor. If you guys are still here, hit that like button if you haven't already. So Josh, here, you got anything to talk about for a moment? We don't really have any questions coming up here that I can.
We don't have a lot of great stuff. We will remind that we are right in the middle of getting content launched over at the Find My Way Home YouTube channel. There will be a lot of my content over there, but again, we have an expert network of mortgage professionals around the country that are going to be contributing to that. So a lot of mortgage specific content, a lot of local content. An example would be here for us in California, there's almost no good down payment assistance programs. In some states, there's awesome down payment assistance. Like in Texas, there's 50 programs that are awesome. So focusing on a lot of that content to help people in different parts of the country. So if you're interested, get ahead of the curve and subscribe over there, and you can be a founding member of the Find My Way Home channel.
All right, here's a good question. So do that if you haven't already. Hit Josh up on YouTube. Will the loan officer consider my home's equity when applying? I'm selling and buying at the same time. So the answer is yes. They will consider that equity. Josh can elaborate on this. It depends on what type of loan you're going to do. Some cases you might need to sell that home and use that equity to buy the other home, right? And there are bridge loans out there too that Josh, if he wants to go down a rabbit hole there, can talk a little bit about a bridge loan if he wants. But the easy answer is yes. They will use that equity if you're using it towards your down payment, your closing costs. It's like having cash in the bank, if you will. They just have to document where that money's coming from. They document that it's coming from your house. You have to show when that house closes, essentially the final settlement statement, probably, right, Josh? That shows that.
So what we do is on your loan application, it's just no different. Hey, I've got $10,000 in Chase and I've got $50,000 in home equity. And what we provide is the estimated closing statement that says, hey, Eddie's going to walk away with $50,000 here. Then prior to closing, we have to show the final settlement statement. And the easiest way then is to take that $50,000 and transfer it over to the new escrow. So we're not having to document the money going into one account and into another. But yeah, it's not treated any different than any other liquid asset. We just have to make it liquid towards the end of the transaction.
All right. Here's a question I saw come up earlier and I was trying to find it and I did not. We addressed this one, I think, last week. If my credit goes up while I'm under contract, does it affect my loan?
It does. So you probably the strictest lender that we have will not let us take into account an improved credit score after your closing disclosure goes out, which is usually about a week prior to closing. But most of them, right up until we send your loan docs and send them out for signing, we can improve the score. We have a client of yours, Jeb, the one that Billy put into contract earlier this week. There's a credit report or a credit card late from January that she has the letter that Chase or Citi agreed, no, you were never late. As soon as we remove that, it's a 100-point increase to her score. We didn't wait. We're putting the loan in process, and as soon as we have the rescore, we'll send it over to the lender. We will attach that to your automated underwriting. They'll rerun it, and then they send to the secondary marketing department who updates the pricing. So you can absolutely fix your credit on the fly. The sooner the better. It gives everyone time to adjust and make the proper adjustments, but you can absolutely do it as you go.
All right. So Jennifer, our moderator here, is asking a question. She's asking, can you recommend channels for new homeowners to maintain their property once purchased and settled? And unfortunately, Jennifer, I cannot. I have not come across anyone. I haven't really been searching it, quite frankly. I'm sure if I did, I would have it bombarded in my feed of people that do that sort of thing, but I haven't. But I will take a look at it and see if I can find somebody out there for next week.
There's like a million episodes of This Old House on YouTube. Just go back and
Bob
watch
Vila. Yeah,
Bob Vila, Norm Abrams, they know everything. And the funny thing is, I love that show. I love that show more than anything in the world. These guys, I don't know who the millionaires are that buy these homes, because they don't renovate homes. They restore them. Like, this dude will sit there and do like 10 weeks worth of work to do what a guy would come into your house and do in like 2 days. And like, who can afford to have these people do this to these houses?
Those guys are like the best of best when it comes to carpenters. And for those, my dad was a carpenter, so like that's the show I grew up watching. Is This Old House, and they would do something, and he would go and try to do it himself. So anyway, I don't have anyone, Jennifer, as of right now. Looking to do cash out refi for 2 properties. Is it better to stagger the process for the 2, or can you do them both at the same time?
1,000% do them both at the same time. It's going to save you trouble, headaches, hassles. I won't say there's never a reason why you would want to stagger them, but we're going to gather the documentation one time, put it all together. We had a viewer of the channel here last year that we did 10 of them for him at one time. So 2 is easy. 10 is a monstrous pain in the rear. But for his purposes and for ours, although 10 is very difficult, doing 10 at one time is much better than doing 10 separate times. Again, all your income and asset docs are going to come in at the same time. The documentation for the rental properties, it's 1,000 times easier to do them both at the same time. If you're here in California, reach out. I can go through it with you. And if you're anywhere else, again, we've got awesome experts that can walk you through it.
All right. So, guys, we just got $5 super chat from Jorge, who's a realtor, I'm assuming, giving us props. So thank you, Jorge. And Carlos one-upped him and said, we're going to give you $20.
So Carlos got us a 12-pack, and George got us a round.
2 beers. Hey, that's all right.
Either way,
I'm appreciative for both.
I am appreciative of both, and I'm going to make sure you pay off. Well, actually, you bought the 12-pack that's in the fridge, so I think you've already paid off these guys.
Too funny. Thank you guys both. It is much appreciated. Maybe the Josh's shirt will buy it. That's going to have the good stuff on it.
Good stuff.
Let's see here. One more question. So Kayla is asking, how long do you think it will take a first-time home buyer to find a home in North Carolina? I've been looking since January. Very frustrating. Can't say how long it's going to take you in North Carolina. Just, what I tell people in this market is just stay true to what you're trying to accomplish. Don't get caught up in the process so much. I know it's emotional. It's difficult. It's overwhelming in some regards. And you're not alone, right? I mean, just hopefully as spring comes around, you're going to see some more property come on the market, especially in areas like North Carolina that have seasons where, it's been cold. In fact, in North Carolina, they've had a lot of rain this year. I know that because I'm from there. And so, there are things that affect supply. the as more people get the vaccine, I think, that is going to help things. So I don't think it's going to change the market in terms of prices going down, but it might affect the ability to have more opportunities for buyers to put in offers on more property, right? So you might, instead of having 20 on people writing offers on one house, you might have 20 writing offers on 4 houses. So it spreads it across it, right? And this is just a guess, all right? It's my theory in how these things are going to play out, right? I have no idea, to be completely honest, but I think you will see more inventory.
I wish we had Kayla here because there's a question that I would like to ask her. But since you are the North Carolinian that is here, I'm going to ask you. My amazing wife made President's Club at work. And it was originally, they were supposed to take us to Monte Carlo for that. Because of COVID, we don't get to go to Monte Carlo. What they've offered,
North Carolina instead?
No. What they've offered in lieu of that is South Carolina.
Oh, okay.
At the Montage, which is a beautiful hotel, in August. Where is it? I don't know South Carolina. That's why I'm asking you. Do you want me to look it up and tell you where it's at?
You should tell me.
Okay, Montage, South Carolina. It looks
the Montage
awesome.
is a great resort regardless, but it's got to be on whatchamacallit island out there. Where
Bluffton, South Carolina.
I don't know. I can't help you, man.
Palmetto Bluff. They all sound the same to me.
Well, here's the deal. I know the Montage is nice, so you're in good shape.
No, Montage was not my question. I know I'm in good hands at the Montage. Do I want to be in the Carolinas in August when the heat index is like 105?
Absolutely not. It's going to be miserable. And there's going to be mosquitoes and flies and bugs. You're not going to be able to sit outside. It's going to be awesome. I want you to experience that, just so you know how.
So tell me how awesome it is, because the trip to the Montage has got to be closing in on $10,000 cost to them. Your option, if you don't want that, is like $2,000 cash to go hang out at your friend's house.
No, you got to go. It's an experience.
All right.
So Michelle, this is a good question. What do you recommend clients in the short term to increase their credit score? So there's a couple things you can do. It's better if you have a copy of your credit report, of your actual FICO score, so you get some, ideas of where things stand. But, one thing you can do is, if you have collections, you have past due accounts, you can try to negotiate those with the collection companies, that if you pay them, that they'll remove those from your credit report completely. You'll get a letter to help do that. I'm going to go really quick here just to make this really short. Some other thing you can do is that typically, if you're more than 50% maxed out on your credit card, so say you have a $10,000 balance or spending limit on a credit card, and you're over that $5,000 threshold, that affects your credit score in a negative way. So you can pay it down to under that 50%. That could boost your credit score. Another thing is, if you can't pay it down, maybe call your credit card company and see if they'll increase your limit. If they increase your limit, and then that might make you under that 50% threshold. Another thing you could do is, if you have a friend, probably a family member that has had a credit card they've been paying on for some period of time, and they have, they're in good standing with that credit card company, never missed a payment, balance is low, whatever, maybe have you added as an authorized user on that account, because that history will transfer to you and potentially add to your credit score. What am I missing, Josh?
No, it's all good stuff. In addition to paying down, assuming, like, a lot of times we have someone that's a 700 credit score, they want to get to a 740 and they owe $7,000 on their $10,000 limit card. That's a bad thing. A lot of times they can call up and say, hey, will you increase my limit? Right. They bump the credit to 15,000, and with them doing nothing, they're now using less than 50% of their limit. And there are multiple tiers in there, and they may not be exactly this, but 30, 50, 70, 90% are important thresholds. If you're above any of them, if you can get just below each one of those thresholds, you're going to have an improvement. And probably goes without saying, but if you're above 100% of your limit, it will obliterate your credit score. I've seen people with perfect credit. I've had clients with 800 credit scores that we help them get into a house, and they run up every credit card they have to 100% or more, renovating the house. And they're like, hey, we want to refi to pay off our credit cards. And they're like a 650. You're like, we got to pay some of this down before we can do anything. Another piece on that for anyone, when we're talking,
Jennifer said, pay your bills on time.
That's also helpful. Helpful. But for anyone who's really, if you're below 640, I have a very good friend. I'm actually going to be speaking on a panel in Atlanta with him at a mortgage conference here on Friday. But they do this for a living. What I can say is an ethical, professional credit repair company. They're going to do all the things that you can and would do yourself.
Absolutely.
They're going to do it faster with a ton less effort. And they're going to be the ones stuck on the phone, beating their head against a wall, talking to idiots. We've had clients that for less than $1,000 spent with them have gone from 560 scores to 650 scores. And on an FHA loan, that means going from not qualifying to getting pretty damn good terms. You know, for our clients that are looking at, they have a 682 and they're like, I would like to get a 740 so I get the best terms. Usually we're pulling the credit, doing a what if analysis and saying, hey, can you pay this down to this? Can you remove that authorized user? A lot of times someone's an authorized user on a family member's card and that family member's jacked the card to the moon. And we're like, just remove yourself. There's a million little tips and tricks. It just depends. Are we trying to make a big move to get to an acceptable credit level, or are we trying to make a little move to get from a good credit level to an even better one to get better pricing? And just so everyone knows, those moves in pricing, if you have a $500,000 loan, the difference between a 700 credit score and a 740 is generally a quarter to a half point in pricing. So $1,000 to $2,000 better pricing. You might as well work on the credit and get that benefit.
No, and I think you said one important thing there that anybody that is trying to do this should know. There's nothing those companies do that you can't do yourself. Mm-hmm. Right? I mean, they do it faster. They have more experience. They can probably make it happen in quicker time frames. But if you have the time frame, you can save the money and do it yourself. Let's take one more question here. It's almost 6:45 here in California. So Georgina, regular viewer, is asking a question about duplexes putting 25% down instead of 20% down. She's being told that she needs to put more down. Is that common? Is her question.
It's not, but this is the primary answer when people say, hey, I just want to go to my bank. I have a relationship with them. Well, the days of us having relationships with our banks have long since passed. Even if you have one of the smaller banks, you still don't really have a relationship the way we used to. So banks, have overlays. Even if they're selling to Fannie and Freddie, they'll have their own overlays of what they're comfortable doing. The big banks, Chase, Wells, all have massive overlays for every type of loan where they will not do loans that other lenders can do 8 days a week. The other thing I would say, banks do a lot of things. They don't do anything well. I can't recall anyone ever telling me, hey, I went to my bank and I had an awesome experience doing X. You went there and they got it done. They were not awesome at it. I had a client we're doing a refinance for. He's a longtime B of A client. And midway through it, he's like, I'm just having a hard time. Your rate's a lot lower. Your fees are a lot lower. I just know it's going to be easier working with them because they're my bank. And said, literally nothing could be further from the truth. They are not good at doing anything efficiently. The person that you're working with is not a professional long-term loan officer. They're a bank employee who is currently doing mortgages while they're employed at the bank. So long rant you can get overlays at banks where they will not do loans that are definitely doable by other sources. Check with a broker, check with a mortgage professional that's been in the business for 10 plus years, and they'll get you on track.
All right, guys. So we are going to wrap it up here. I would ask a favor again, if you haven't already, hit that like button. If you appreciate us being here, you like the content, you want us back next week, that would be helpful. I put a link here, and the reason for it is because I get a lot of people asking me for mortgage professionals, for real estate professionals, whether it's in California or across the United States. So I created a link for you guys to go to. You fill out some basic information. Obviously, the information is not being sold or anything crazy like that. It is merely, a pathway for me to gather the information that I need to refer you to the right people. I'm not getting anything out of this other than knowing that you are taken care of, and that is my primary source of doing it, and the reason that I'm here to do this whole thing. So I appreciate you guys. Josh, anything you want to add before leaving today?
No, just thanks for being here and just being committed to your financial future. It's a crazy market, weird stuff. So it's more important than ever to have experts on your side. Appreciate you guys showing up and trusting us, Jeb and I, as experts, and having us share our opinions with you. And hopefully you're getting value from the questions that we're answering.
No, absolutely, guys. Once again, appreciate you for being here. Thanks for the super chats. Thanks for the support. We will see you again next Wednesday at 5 p.m. Have a great night.